I think that certain sectors are, and maybe it goes back to the reason we need interest rate cuts.
Hello again and welcome to the Week Ahead on Nomura Podcasts. I'm your host Dominic Bunning, Head of G10 FX Strategy in Nomura's London office, and today is Friday, the 5th of December. Well, markets have been a little bit more subdued in the last week, but we do expect plenty of excitement in the run-up to Christmas. There won't be much time to settle down for mince pies and mulled wine this week, as we'll be focused firmly on the Federal Reserve's rate decision on Wednesday, the 10th of December. US Treasury Secretary Scott Bessent was clipped there at the top of the show, stating his preference for rate cuts, and the market seems to agree with him, at least for this meeting, with at least a 90% probability priced into the rates market that the Fed will deliver a 25 basis point cut. However, there are plenty of ambiguities around the decision and the Fed's communication, as well as some interesting developments to watch on the board's potential composition looking into 2026. We'll discuss all of this with Jeremy Schwartz from our US economics team later. We've also seen a significant shift in rate pricing in Japan, which has helped the yen to stabilize as well. We'll be talking to Yujiro Goto from our Tokyo office about what to watch on these fronts in the next few weeks. Looking further ahead, we've just published our year ahead report for Asia, which Euban Paris-Wellers will be talking us through. And in Europe, Josie Anderson looks ahead to the SNB decision in Switzerland and lays out what's been going on in the UK ahead of the late December Bank of England meeting. So plenty to get through this week. With no further ado, let's get stuck in.
I am going to start advocating going forward, not retroactively, that regional Fed presidents must have lived in their district for at least 3 years.
Well, we're going to start where all the action is this week in the US ahead of the Federal Reserve's rate decision next week. We've already heard on the podcast from Treasury Secretary Scott Bessent on why he thinks we need rate cuts, and also his view there about regional Fed president appointments and how the committee potentially could change over the months and years ahead. So let's see what Nomura's US economics team has to think about it. And we've got Jeremy Schwartz here. Thanks, Jeremy, as always, for joining us. Let's start with the obvious question. What's the Fed going to do at next week's rate setting meeting?
Thanks, Dom. It's great to be back. And the December decision remains an incredibly close call. In our view, the committee does seem evenly divided between officials who favor a cut and those who would prefer to remain on hold. For a long time, actually since the afternoon of the October meeting, we had thought that the Fed was going to remain on hold. But at this point, it does seem more likely than not that they will go ahead and cut. And there's really two reasons for that. The first is, even though in our view the labor data have been more or less constructive, I think there have been enough concerning signs in a couple of indicators that the Fed, who seem to be constantly on guard against downside risks to employment, are likely to kind of keep their guard up there and potentially deliver another insurance cut, even though the broader data haven't deteriorated. I think the other point is just on Fed speak. It's interesting that since the October meeting and the October minutes, you really have two camps, the hawks and the doves, and no real sign that anyone in either faction has reacted too much to the data one way or the other. That leaves this meeting pretty much down to Powell and a handful of his close allies. We had interpreted the October press conference as being quite hawkish, as indicating a high threshold to cut at the December meeting and kind of requiring a different logic, as Powell said, relative to the past insurance cuts. But that said, at this point, and we're recording this on Friday morning, we've been through almost a week of the blackout period now, with the market priced to a near certainty that the Fed would cut. So there are still risks. We've seen a willingness to guide markets through kind of media leaks in the blackout period. And I think the preview articles from the Wall Street Journal and New York Times, which typically come out Sunday or Monday before the meeting, are still an important risk hurdle to get over. But at this point, having not seen any attempt to guide the market away from that cut pricing, we have to assume that Powell could be comfortable with it and could be ready to deliver what the market's expecting.
Yeah, I found it quite fascinating, really, just how confident the market seems that the Fed will deliver that cut, given that the data hasn't really been, a slam dunk, effectively, in terms of deteriorating in such a way that suggests the cut is completely necessary. But we are where we are, as they say. Looking a bit further ahead, we're going to get a bit of guidance in the SAPs. We want to talk a little bit about 2026 as we are at that time of year. Global outlooks coming out, all these things. What do you think are going to be the key drivers of US rates in 2026? Should we be concerned about the labor market? Is it inflation? Is it something else in terms of just the makeup of the board? How are you thinking about those rate decisions looking a little bit further ahead?
Yeah, well, certainly the makeup of the board and Powell's successor is going to be a hugely important factor. And we're really thinking about 2026 as a year of two halves, with Powell remaining as chair up until May, and then his successor with NEC chair Kevin Hassett seeming to be the front runner now, kind of taking over from the June meeting and beyond. Now, that said, I think you still have to convince a committee to go along with what you want to do. The chair is not a dictator, so it's not as if the June meeting you should expect a rapid return to easing. But I think if the data are in some sort of gray area, if there are more close calls, then I think we should expect those to kind of start breaking in a more dovish direction once Powell's replacement is in place. The other point on that front is the turnover of the regional Fed presidents becomes a bit more dovish as well next year. And finally, if Powell does resign his board seat after his term as chair is up, then Trump will have another opportunity to appoint a kind of sympathetic governor. So, thinking through the year, we actually do think that after the December cut, Powell is done with cuts for the remainder of his term. So we don't expect any additional easing through May of next year. And that's not because we think that they're kind of unwilling to cut or that they're going to deliver credible hawkish messaging at this meeting. And frankly, we saw hawkish messaging in October, and that didn't seem to stop them from being comfortable easing again in December. So it's kind of hard to be credible that they think they're done. But what we do expect is that growth will actually reaccelerate into the start of the year. We expect inflation data to pick up as well as you get a little bit more tariff pass-through through the holiday season, plus Q1 residual seasonality, which has pushed inflation higher in recent years. And so even though we think that Powell will remain dovish and will remain on guard against labor market risks, we don't think the data is going to be there to justify him delivering additional insurance rate cuts. Once we get his successor in place, we do expect that a handful of cuts are more likely than not. And again, it's not necessarily about what they want to come in and do, it's what the data allow them to do. And on that front, the tariffs are perversely kind of helpful because it actually sets an inflation peak at the start of the year and makes it very easy to make progress on the headline inflation data. So the ability to say we're moving towards 2% is likely to encourage more centrists on the committee to potentially back additional easing. So for now, we've penciled in another 50 basis points of cuts, terminal rate down to 3 1/8.
Okay, thanks, Jeremy. You just mentioned there a lot of, obviously, the kind of Fed makeup, the kind of almost the year of two halves to some extent, and the inflation side. Just on the labor market more broadly, how are you thinking about that? It looks like most of the data is still pretty resilient, really. I know some of the private sector jobs numbers are a bit softer, but you guys are still pretty sanguine in terms of the overall labor market outlook?
Yeah, so we think the labor market is resilient. We think it has been resilient for several years now. And while you've seen these momentum swings and fluctuations in the headline job numbers, really the consistent trend is that you haven't seen any pickup in layoffs. That's the factor in labor markets, which often leads to those nonlinear deteriorations around cyclical turning points. And so, again, seeing that people are keeping their jobs, seeing that wage growth remains healthy, that means that consumer finances are going to be well supported. It means that people are going to be able to keep spending. And again, that means that even if the headline job numbers are cooling, even if the unemployment rate is kind of drifting higher off of a relatively extreme low, we don't have too much to worry about. Actually, going into next year, I think we're becoming even more optimistic because we think some of the labor supply constraints from this year are likely to ease up a little bit, which should allow headline NFP to reaccelerate. And if we're correct that cyclical momentum is going to pick up as well, then we actually think the unemployment rate is likely to peak relatively soon. So we think it reaches its high around 4.4, 4.5, and then starts trending lower in next year. That said, in terms of the Fed's reaction function, it often seems to be the case that they're not looking at all the data and coming to a conclusion. They're almost picking the worst of data in a basket of indicators. And we saw in 2024, Powell reacted strongly to rising unemployment. Now in 2025, he used the curious balance and the slowdown in payrolls as a reason to ease. And we actually think that some of the private sector data you cited, things like ADP, will potentially be behind the factor to deliver that final insurance cut at the December meeting. So again, I think it has been fundamentally healthy. There have been some weak spots and some yellow flags, and the Fed has reacted aggressively to those. We think that can continue, but if we're right about this momentum acceleration next year, then more likely than not, we think that they're going to remain on hold until the new Fed chair is in place.
Brilliant. Thanks, Jerry. Really helpful and insightful as always. And we look forward to next week's meeting and all the vagaries and things that come with it. And I hope you look forward to it too. Well, we're going to stay with monetary policy, but we're going to shift focus to Japan, where I'm joined by my colleague from FX Strategy in Tokyo, Yujiro Goto. Goto-san, thank you very much for joining us. Look, the BOJ has come much more into focus, and it does seem like a December rate hike is firmly on the table. What's changed in the last couple of weeks that has really meant that the BOJ is likely to hike in December, in your view?
Yes, thanks, Tom. So I think Governor Ueda's speech and press conference on the 1st of December was very important because he clearly stated that he and the board members are going to discuss a rate hike at the next policy meeting in December, which is quite a similar expression with Deputy Governor Himino's comment back in January, just before previous rate hike. So this is quite a clear signal from Governor Ueda that the BOJ is considering a rate hike at the next meeting in December. And behind these changes or communication changes, I think yen weakness is really working quite important role. Because recent media articles suggest Takaichi administration is now comfortable with BOJ's rate hike in December, simply because government is concerned over rapid and weakness in tandem with higher JGB yields or steepness in the JGB curve. So I think weakness changed the BOJ and the government stance on rate hike. And that changed Governor Ueda's communication this Monday.
Okay, interesting. So, the combination of the sort of market reaction to what we've seen, and also, I guess, the underlying inflation pressure still allowing the BOJ to hike are certainly in play. Well, when we look ahead then to 2026, what do you think could possibly cause the market to price in an even faster rate or faster pace of rate hikes? Do we need to see the yen weakening to get those rate hikes, or could the BOJ potentially hike even in a scenario where the yen is stable?
Yeah, so I have to say our main scenario is after December rate hike, we do not expect additional rate hikes in 2026 as our main scenario, but I think risk is actually a bit more aggressive rate hike in 2026, and clearly further yen weakness can be a catalyst or driver for earlier rate hike by the Bank of Japan. But I think it's interesting that recent development about December rate hike communication suggests kind of tolerance against yen weakness of the Takaichi administration is much lower or weaker than many anticipated initially. So I think just a stable underlying momentum above 150 can actually enough for BOJ to front load its rate hike into early 2026. And also, what's really interesting from the recent media article is that Bank of Japan is currently considering re-estimate of its neutral policy rate estimate. And Bank of Japan has been suggesting that the neutral rate in a nominal term is somewhere between 1% and 2.5%. But that is based on a little bit outdated information like potential output growth estimate. And if the Bank of Japan uses updated higher potential growth estimate as an input for neutral rate estimate, we can get a higher neutral rate from here. And in that scenario, I think Bank of Japan need to convey rate hike cycle will be much more sustainable, and also terminal rate will be much higher than currently market anticipates. So I think if we have more aggressive neutral rate estimate from the Bank of Japan, either in the December meeting or January meeting when the Bank of Japan update its quarterly outlook report, I think the market need to price a more aggressive rate hike, which can also support Japanese yen in 2026.
Yeah, that's a very good point about the terminal rate. You know, if the BOJ is thinking that neutral could be a lot higher, then certainly something the market isn't really looking at, and something that could definitely drive a bit more yen strength. So definitely something we need to be very aware of in our space. Thanks very much, Goto. Sam, really good to speak to you, and we'll catch up with you soon.
Thank you, Dom.
We're going to stay in Asia now, but move away from Japan. And I'm very happy to be joined by Yuben Parasueles, our chief economist for ASEAN. Yuben, thank you very much for coming on. I know you've had a busy week over there in Asia because you've just released the year ahead report for 2026 from sort of an economics and strategy perspective. It sounds like it's a bit of a mixed outlook. Who do you guys think are going to be the winners and losers in economic terms out in Asia in 2026?
Yeah, hey Don, thanks for having me. I'll just give you a little bit of a teaser because in the next few weeks we'll have dedicated episodes to our year ahead. For Asia, we've got growth on aggregate at 3.6 for 2026. That's kind of stable, I would say, from 2025, but it really masks a very stark differentiation in economic performance that we're expecting across these countries. The sources of differentiation, well, tech, we still think tech exports are going to have strong momentum led by AI demand and, chip prices going up. But non-tech exports are going to be remaining soft because of the impact of the tariffs, but also our view that the Chinese economy will be relatively weak. And if you look at domestic demand, yeah, it's going to be a little bit of a mixed bag as well. Some countries with still very supportive policies, but then there are others that are facing political uncertainty in Thailand and the corruption scandal in the Philippines. So to your question on winners and losers, if you put it in that framework, we've got Korea, Malaysia, Japan, Singapore, and Taiwan and India actually outperforming growth versus consensus, whereas China, Thailand, and the Philippines will be in the laggard camp.
Okay, interesting. And the question we always get from clients, is what are the big out of consensus views, or where are the sort of big surprises likely to be? If you were to flag maybe one or two of the biggest potential shocks out there, what would you have as your key surprises?
Yeah, I'll give you a couple. So one is really this big divergence between the two giants of the region. So China, we think, is going to be below consensus in terms of growth, whereas India is going to be above consensus. And then when it comes to monetary policy, again, we've had very engaging debates with clients when we had our outlook presented yesterday on this idea that most or other central banks in Asia will be coming to an end already in their easing cycles, even though we still have the Fed potentially cutting next year. So places like Bank of Korea, and even I would say the hiking central banks. I've got the hike in BNM in Malaysia at the end of next year. And then we've got the BOJ hiking December, and then potentially a few more further down the road. So a little bit of a divergence again from a monetary policy perspective, and a sort of a decoupling from the Fed, with some of these central banks ending their easing cycles already.
That's definitely something we need to watch in FX as well. That sort of potential divergence on monetary policy, always a pretty key driver for currencies. Just pulling it forward to just, the week ahead rather than the full year ahead. What are you focusing on this week in Asia?
Yeah, so we have a couple of central banks, so BSP and RBA. Let's talk about the RBA. But for BSP, we have them cutting by 25 basis points to 4.5%. The benign inflation outlook continues to allow the BSP to focus on supporting growth, and growth is really under tremendous pressure now. Domestic demand has been weakened a lot by this corruption scandal that's been ongoing, and our view is this is going to continue for a while, at least 1 to 2 quarters. And BSP would want to be preemptive to try and support growth as much as they can. So I would say, BSP cuts next week. I still have another 50 basis points of cuts after that. So the tone from next meeting will be pretty dovish as well.
Yeah, you touched upon the RBA, almost a complete 180 view there compared to what you're talking about in the Philippines. We've got rates being left unchanged and actually quite a hawkish potential outlook for Australia. It's been one of the reasons from a currency perspective we've been pretty positive on the Aussie over the last month or so. The RBA's cutting cycle has likely finished a little while ago. And actually what's interesting is we're starting to have discussions about whether the RBA could actually hike in 2026. Now, that's not part of our base case, but certainly something to watch, and the communication from the RBA, sort of whether that discussion is starting to play out on the board, is certainly something to watch. And if we do get any confirmation that might be the case, then I think plenty of potential for, as I say, for the FX market to continue to price in an even more optimistic scenario for the Australian dollar. So it's all going on down there, down under, and sounds like plenty of things to watch in Asia for the year ahead. So thanks again, Euban, for joining us, and we'll speak to you soon.
Yeah, thanks, Doug.
We've been quite central bank heavy so far this podcast. We'll keep it that way, at least for the start of our European section, where I'm joined by Josie Anderson from our European economics team. Josie, thanks as always for joining us. Your main focus this week, I guess, is the SNB in Switzerland. No rate changes expected there, but is there anything you think might happen that could surprise the markets with the SNB?
Yeah, well, when we look at the data on Switzerland, we had a 0.5% contraction in GDP in Q3. That's on the sports adjusted measure. No inflation, 0.0% year on year in November. But yeah, we agree with the market that they're not going to cut. And that's because comments from central bankers have said that the bar is high to a rate cut to negative because they're acutely aware of the side effects of negative interest rates. And they probably say the current rate is accommodative, so it's supporting inflation rising. But in fact, they forecast inflation to rise at the last meeting in September, and it's fallen in the latest 2 prints of data. And so I think we'll see probably a revision to their forecast for inflation downward slightly because it hasn't gone on their path. So I think we'll be looking out for comments on inflation and where they expect it to go, and also on how they're responding to the trade deal between the US and Switzerland. So this was some good news we've had since the last meeting as well. 15% tariff on exports to the US rather than the 39% that was previously in place. But of course, it's come at the cost of significant investments of Swiss companies making in the US. So that actually might dampen domestic production long term if that production is happening in the US instead. So I'll be looking out for their views on GDP growth as well.
Yeah, I guess the other interesting facet with the S&P is always the currency as well, which right now probably isn't as much of a challenge. It's sort of back to levels which it was averaging at sort of through the middle of 2025. But certainly expect the S&P to be present in the market if you start to see more aggressive currency strength, I suppose, especially with those inflation trends seeming to drift to the downside. We've also got a few central banks coming out the week after, but Bank of England is one of those, and we've got a few comments coming through from the BOE speakers in the week ahead. And we've also got a few bits of data. Just in summary, how are you thinking about the sort of landscape ahead of that late December BOE rate cut? Sorry, let me start again. How are you thinking about the landscape ahead of that late December BOE rate decision? We've obviously got a cut priced in. Is the data supporting that? How are you looking at the week ahead in terms of what could or couldn't change that view?
Yeah, thanks. I think, we've seen some knife-edge decisions from the Bank of England over the last few meetings. The last cut was a 5.4 cut, and then at the November meeting, we also saw a very close decision to hold. And so I think a lot of the data has come out softer since then, particularly the labour market data with a rise in the unemployment rate. So that supports a December cut. Next week, we have inflation expectations data, and some of the more hawkish members, you could call them, of the MPC have been concerned that inflation expectations have been persistently high. And so if this survey comes out with lower inflation expectation for the coming year, for the coming 5 years, then perhaps that will give more confidence to some of the members who voted to hold that they can vote for a cut in December. And so we'll be looking out for that. GDP growth has also been quite weak. It was weak in Q3. We expect a slight rebound in October, but I doubt that will swing the dial on whether or not they cut, because it's been so weak lately anyway.
Okay, thanks, JC. So it still seems to be, things still must be in place for the BOE to cut in December. But you mentioned their inflation expectations. We've also had some inflation data, both last week and coming up this week in Scandinavia, Norway and Sweden. Any thoughts on the inflation outlook there?
Yeah, so we had Sweden headline data out this past week. We'll get the detail next week. That came out lower than we consensus were forecasting. That's after an upside surprise in the previous print. So we've seen some swings, but actually the overall trend in Sweden is that inflation is slowing and will slow into next year because of tax changes, particularly a cut to food VAT. We don't expect that to affect the Riksbank's policy rate, though, because it's already at the low end of neutral. In Norway, we get inflation next week. We actually also expect it to reverse its surprisingly high print in October, and that's in November print. We could see perhaps some discounting associated with Black Friday that seems to have become a global phenomenon now. There have also been some government policy changes that have affected inflation in Norway, and actually last month we saw the statisticians revise their estimate because of this new Norway price scheme that guarantees a fixed price for energy. So it's made energy price forecasting slightly more tricky. It's like households have to opt into, so we don't quite know how much it's affected the whole basket and prices for energy. So we'll be looking out for that as well.
Oh, super interesting. So quite a few things, moving parts there in Scandinavia, a lot of moving parts in the UK, and obviously the S&P rate decision as well to look forward to. So a bit of a mishmash of different things in Europe this week, but certainly lots for us to focus on in the week ahead. Thanks a lot, JC.
Thanks, Tom.
Well, that does it for this week. Thanks to all our contributors. Thanks to John Dalton, who edits and produces the podcast. And thank you to all of the listeners for joining us again. We would love to hear your feedback, so please do leave a review or comment and let us know what you like, what you want to hear more of, and what we can do better. Please like and subscribe to Nomura's podcast on Apple, Spotify, SoundCloud, or wherever it is you get your podcasts, and share this far and wide with anyone you think would find it interesting. You can also check out nomuraconnects.com for more of our content. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connect at www.nomuraconnect.com.